As of this moment on Friday, March 6, 2026, the stock market is currently open and active for the final trading session of the week. Nvidia stock is currently trading live at $179.42, marking an intraday decrease of 1.12% from its previous close. This price action comes amidst a high-volume session where investors are weighing the long-term sustainability of the semiconductor giant's growth against immediate macroeconomic pressures and a tightening regulatory landscape. While the headline figures for Nvidia might seem like business as usual for a company that has dominated the last few years, there is a massive gap developing between what the public expects and what the internal mechanics of the company are actually signaling. Most people looking at an online investment platform or a popular investing site see a company that just reported record-breaking revenue of over $68 billion for the quarter. The expectation is that this momentum is an unstoppable force. However, the reality is that for the first time in this cycle, the market is beginning to punish perfection. Even after beating earnings expectations, we've seen the stock struggle to hold its gains, a phenomenon that suggests a major shift in investor psychology. We are moving away from a phase where any growth is good growth to a phase where the market is scrutinizing every dollar of capital expenditure. If you are using a Fidelity trading platform or the Robinhood app to track your holdings, you've likely noticed that Nvidia stock has become a battleground of volatility. One insight that most retail investors are overlooking right now is the sheer scale of Nvidia's purchase obligations. While everyone is focused on the $4.4 trillion market cap, the company has quietly locked itself into nearly $95 billion in supply commitments. This is the ultimate high-stakes poker move. Jensen Huang is essentially betting the entire company's flexibility on the belief that demand for Blackwell and the upcoming Rubin platforms will not just remain high, but remain parabolic. If demand even slightly normalizes, or if a few major hyperscalers, the very companies you see when searching for Apple stock or Tesla stock, decide to pause their infrastructure spend, Nvidia's balance sheet could become very heavy very quickly. It is this tension between the insatiable demand narrative and the overextension reality that is driving the current price fluctuations. Before we get into the heavy institutional activity and the shifts we're seeing in individual brokerage accounts, I want to hear from you. Comment below how many shares of Nvidia stock you currently hold in your portfolio. Are you adding to your position at these levels, or are you starting to look at other options like Fidelity ETFs, or maybe diversifying into something like SoFi stocks? Your feedback helps gauge the sentiment of the actual boots on the ground. Recent movement in Nvidia stock has been heavily influenced by the China foreclosure reality. In their most recent annual report, the company admitted they are effectively blocked from the Chinese data center market due to U.S. export controls. This resulted in a massive $4.5 billion charge for excess inventory. For the smart investor, this is a clear signal that the geopolitical risk is no longer a theoretical threat. It is a tangible line item on the balance sheet. When you look at investment help articles or browse investing sites, they often gloss over these charges as one-time events, but the reality is that these restrictions strengthen local competitors in China, permanently shrinking Nvidia's addressable market in one of the world's largest tech hubs. Institutional activity has shown some interesting divergences recently. While some firms like Tempest Wealth Planning have slightly reduced their stakes to lock in gains, many of the heavy hitters in Fidelity Wealth Management and Interactive Brokers trading circles are still holding firm, betting on the agentic AI shift. This is the idea that AI isn't just for chatbots anymore, but for autonomous agents that run businesses. This is where the expectation of a tech bubble meets the reality of utility. If AI transitions into a productivity tool that replaces labor costs, the valuation of Nvidia could still have room to run. But if it stays in the realm of expensive experimentation, we could see a significant re-rating of the entire semiconductor sector. If you're managing your own money through self-investing or using a SoFi robo-advisor, it's important to understand the business model that got us here. Nvidia doesn't just sell chips, they sell a full-stack ecosystem. Their CUDA software is the moat that keeps developers locked in. It's the reason why even when competitors launch new hardware, the industry default remains Nvidia. However, the cost of maintaining this lead is astronomical. R&D spending has topped $76 billion over the company's lifetime, and the cadence of new product launches is accelerating. They are now moving to a one-year product cycle, which puts immense pressure on their engineering teams and their supply chain. This is a treadmill business model. If they stop running at full speed for even a second, the competition catches up. The broader market environment is also playing a role, with the S&P 500 and NASDAQ showing sensitivity to inflation data and global tensions. Even a titan like Nvidia isn't immune. We've seen a trend where investors are moving cash into more defensive Fidelity mutual funds or looking for stability in Schwab Intelligent portfolios. The risk-on appetite that fueled the initial AI surge is being replaced by a show-me-the-money attitude. Investors are no longer content with high revenue growth. They want to see that revenue translating into sustainable free cash flow that can survive a potential economic cooling. Looking ahead, the catalysts for Nvidia stock remain centered on the rollout of the Blackwell Ultra and the transition to the Rubin platforms. These are the reality checks that the market is waiting for. If these launches go smoothly and the $78 billion revenue guidance for the next quarter holds up, we could see a return to the 52-week highs. However, the risk of a digestion period is real. Major customers like Microsoft and Amazon have spent hundreds of billions on chips. At some point, they have to stop buying and start building the software that generates a return on that hardware. This is the pivot point where the expectation of perpetual growth meets the reality of capital cycles. Whether you're using Robinhood investments for quick trades or Fidelity IRAs for the long haul, it's important to understand the commitments, not just the headlines. Nvidia is a company that has successfully anticipated every major turn in computing for a decade, but they are now operating at a scale where even small errors in demand forecasting can have multi-billion-dollar consequences. The intraday movement we're seeing today at $179.42 is just a small reflection of this much larger, complex struggle between a visionary management team and a market that is starting to ask very difficult questions about the future. In summary, the expectation for Nvidia remains one of total market dominance and unceasing innovation. The reality is a company navigating intense geopolitical headwinds, massive balance sheet commitments, and a customer base that is increasingly looking for ways to reduce their dependence on a single supplier. The contrast between these two forces is what will define the stock's performance through the rest of 2026. This isn't just about a chip company anymore. It's about the backbone of the entire modern digital economy, and that makes the stakes higher than they have ever been. Keep a close eye on the volume and the institutional flow, as those will be the first indicators of which way this tension ultimately breaks. Would you like me to analyze the recent institutional 13F filings for Nvidia to see which major hedge funds are currently increasing or decreasing their positions?